Everyone thinks stock prices move because of the news. A headline drops, markets react. Prices move. Simple, comfortable. Wrong, because if news actually moves stock prices the way people think it does, the market would be one of the most predictable machines ever built. And it isn't. The uncomfortable truth is this. By the time you're reading the news, the price move is already over. Not because the market is unfair. Not because it's rigged, but because news is no longer the cause, it's the excuse. Let's start with why this matters right now. Because believing the news moves markets leads people to constantly arrive late. Late to rallies, late to crashes, late to reversals. And it creates a false sense of understanding. You feel informed. You feel prepared. And yet, your timing keeps failing. That's not a personal flaw, it's a misunderstanding of how prices actually move. So if it's not the news, what is? To answer that, we need to strip the market down to its mechanics. At the most basic level, stock prices move for one reason only: imbalance. More buying pressure than selling, prices rise. More selling pressure than buying, prices fall. Everything else is secondary. News doesn't move prices directly, orders do. And most of those orders are not coming from people reacting to headlines. They're coming from systems responding to constraints. That's where the real story starts. Let's rewind to how the news narrative took over. Decades ago, markets really did react to news. Information was scarce. Distribution was slow. Interpretation took time. A surprising earnings report could genuinely change beliefs. Prices adjusted as people updated their views, but that world is gone. Today, information is instant and universal. The moment news breaks, it's everywhere. Which means it can't be an edge. And if it's not an edge, it can't be the driver. So why does the market still move around news? Because news is often the trigger, not the force. Think of news like a spark. It doesn't determine how big the fire gets. It just lights what's already soaked in gasoline. That gasoline is positioning. This is the first hidden mechanism most people miss. Markets don't move based on what's happening. They move based on how traders are already positioned before it happens. If everyone is already bullish, good news has nowhere to go. If everyone is nervous, even neutral news can cause a sell-off. This is why markets sometimes fall on great headlines and rally on terrible ones. The news didn't fail. Your assumption did. Now let's talk about who actually moves the market. It's not retail traders reacting emotionally. It's large pools of capital following rules. Pension funds, index funds, ETFs, risk parity funds, volatility targeting funds. These institutions control trillions of dollars. And they don't trade because of opinions. They trade because something in their model changed. Volatility up, reduce exposure, correlations rising, sell diversification, momentum broken, exit positions. None of this requires news. In fact, most of it happens regardless of news. This is why markets can drift for weeks with no clear narrative, and then suddenly move violently on a headline that doesn't seem important. The headline didn't cause the move. It unlocked it. Now we get to the uncomfortable math. When volatility rises, many funds are forced to sell. Not because they want to, because they have to. Risk limits are breached. Leverage becomes unsafe. Models rebalance. That selling pushes prices down. Lower prices increase volatility, which forces more selling. This feedback loop has nothing to do with fundamentals. It's mechanical. And once it starts, news becomes irrelevant. This is how you get cascades. The market doesn't fall because people are scared. People become scared because the market is falling. Now add speed. Most of these adjustments happen automatically. No committee meetings, no debates, no second thoughts. The market moves first. Humans explain it later. Which brings us to one of the biggest misconceptions in finance. The idea that the market is digesting information. It's not digesting. It's reacting. And reaction doesn't require understanding. It only requires triggers. This is why explanations always arrive after the move. Commentators scramble to connect dots. Rates, inflation, geopolitics, earnings. Sometimes they sound convincing. Sometimes they contradict yesterday's explanation. Because they're not describing causes. They're telling stories. And stories make randomness feel intentional. Now let's address technicals, because this is where things get awkward. Many people dismiss technical analysis as astrology. But here's the irony. Technical levels matter not because of lines on a chart, but because so many systems are programmed to respond to them. When a price breaks a level, it triggers orders. Stop losses, margin calls, trend reversals. Those orders move prices. That movement triggers more orders. Again, no news required. This is why nothing happened days can be the most violent. Something happened in the structure, not the world. Now let's contrast this with the news-driven fantasy. The fantasy says, news gives interpretation, gives decision, gives trade, gives price. Reality looks more like this. Positioning gives trigger, gives force, trades, gives price, gives narrative. The narrative comes last. Always. And this creates a dangerous habit. People wait for confirmation. They wait for headlines to make sense of price moves. By the time the story feels clear, the risk is already highest. Because the structural move has already happened. Zoom out further. Why does this persist? Because news is emotionally satisfying. It gives us villains, heroes, causes, and effects. Flows, positioning, and constraints are boring. They don't make good headlines. Market down due to volatility targeting deleveraging doesn't trend, so we get stories instead. Even professionals rely on them, not because they're accurate, but because they're communicable. Now here's the part most people really don't like. Even when news does matter, it matters asymmetrically. The same headline can mean opposite things depending on context. A strong jobs report can be bullish or bearish. A rate cut can be reassuring or terrifying. The difference isn't the news. It's expectations and positioning. Advice that says, watch the news without asking, how is the market positioned, is incomplete. Now zoom out to the bigger implication. If news doesn't move stock prices in a clean, reliable way, then being informed is not the same as being prepared. You can know everything and still be on the wrong side of the trade. This is why so many smart people feel blindsided by markets. They were reading the world. The market was reading itself. So what actually moves stock prices? Constraints, flows, leverage, positioning, volatility. News just tells these forces when to act, not how far to go, and that's the final uncomfortable thought. If markets aren't reacting to reality, but to how capital is structured and forced to behave, then the question isn't what's going to happen next. It's where is the pressure building right now? And more importantly, if the biggest moves happen before the story makes sense, how many times have you been right and still been too late to matter?